Back in Brussels, where coffee is the black gold. It keeps us going, and it's so much better than crypto coins. Welcome everybody back into the room. We hope that you have some new energy, and it's time for our next panel. And I'm most pleased to introduce Florence Bindel, who's a good old friend. Please, she will take charge of the next panel from European issuers. Please, the floor is yours.
Thank you. Thank you, Ruben. I would like to, without any further step, invite the panelists to join me in the seat. So we have Maria Zani, Head of Financial Services, Public Policy, Regulatory Affairs, EMEA at Amazon Web Services. Henriette Peucker, Chief Executive Officer, Member of the Board of Dutch Action Institute. Joe Heve, who will be online in a moment, Senior Officer at ESMA, and Adam Kostial, Senior Vice President and Head of Listing EMEA Nasdaq Nordic. The first one will tackle the first trend of the SAU, if I may introduce it this way, because it's mentioned improving capital availability and access for all businesses, including small and medium enterprise. And in this context, what do we need to do to answer the needs of companies? What are the challenges, the opportunities to finance the transition, and the considerations that we should keep in mind from the perspective of the corporates? And I would like to start with you, Henriette, and I have your perspective. You know, what do you think are the current EU incentives, and are they sufficient in order to meet business needs? What are the challenges? What would you recommend?
Thank you very much, Florence. The Swedish minister this morning said a lot of things that were very, very right. And I wish I could just take the slides and circulate them in Germany and they would be read and taken on board. Unfortunately, life isn't as simple. There's also some hopeful language, but to my mind, not quite enough ambition and thinking sort of out of the box in the communication that was issued yesterday on the Savings and Investment Union. It is a strong push for more of the same rather than a very different approach. But it's a strong push and there's also ground for optimism. We'll see what is exactly in the package. So going back one step, what do businesses actually need? Businesses need an environment where they can get loans, but also financing for equity. If equity is the question, you need the right VC environment, but you also need the right environment for businesses to grow out of a VC stage, and also for family-held companies who want to grow and can't get the money internally, to want to go to public money and public markets. For the moment, Europe does not provide that environment. Part of that is regulatory burdens, but more importantly, simply is we don't have the incentive for all of our money to flow into markets and to ask for this environment to be there. So the key, and the Swedish minister said it quite rightly, is the pension system. And I also think you shouldn't ask for financial education before introducing. You need to do it in parallel. People need to practice rather than be taught. I very much like that line. I'm going to use it going forward. So putting money into the system will create a better landscape of investors, better counterparts for companies to explain how their business models make money and hence why people should invest in them. Because what I am hearing from my members is that it's, depending on their business models, actually not so much fun sometimes to talk to investors who are looking, whose knowledge across the Atlantic or even across the Channel about their businesses is far greater, and they are quite frustrated with some of these conversations. Our suggestion is a very political one. We think that if Europe wants to coordinate something which is essentially a national competence, The only way to do it is, as we have done in the area of the green transition, you set a political goal of a percentage that you want to go and use. So you take, let's say, 2% of wages and say it's a political goal in Europe for every member state to have 2% of wages go into capital markets-based pension systems. And then you tell every member state, you've got different social system, you need to figure out how you make it happen at home. So you do not go and tread on anybody's feet and competences, and at the same time you actually get a benchmarking that isn't just a benchmarking, but a benchmarking towards a goal. And that would be for us the main improvement that we would want to see. And we do think there's a lot following up from that once the system sort of gets going, and Sweden is a very good example of that, that this assumption can work.
Thank you. We discussed these concrete elements, and you are suggesting some of them during the break just before this panel. I would like to turn to Joe, who's online now, and ask him from the regulatory perspective. I mean, what are the challenges when it comes to boosting the financing of European companies, and how do you can ensure, you know, this stability in terms of the financing of the green and digital transition?
Yeah, thank you, Florence, and good afternoon to everyone. Sorry I can't be there in Brussels in person, but it's great to be involved in today's debate. From the regulatory perspective, I think the challenges that we face are, well, they're multiple, but if I could point to two in particular, which are, I guess, overarching aspects. One is on the attraction of more risk capital to finance innovation and growth, and the second would be on when we boost that capital, can markets function efficiently to actually make sure that that capital is allocated seamlessly to where it needs to go. On the first aspect, on boosting capital, I think that this naturally involves retail and institutional side. On the retail side, what's key is about empowering retail investors to engage in capital markets. It's not about taking 10 trillion euros worth of savings and putting that from bank account into capital markets, but it's about providing the incentives, the choice, and the avenues for citizens to decide and to be encouraged to come to the capital markets table. Once they come to the table from the supervisory perspective, it's important that they can make informed choices based on clear information and a foundation of financial education and investor safeguards. I agree that financial education is not necessarily a prerequisite, and it can act in parallel, because ultimately incentives and proper avenues that can be implemented by national governments and EU policymakers, they can be an encouraging factor to promote financial education by citizens once they see that they have opportunities in the capital markets. Likewise, for institutional investors, I think that these are perhaps even more crucial in the context of SIU, because they have the capacity to finance large-scale green digital projects and other strategic projects for the EU. And they do so quite often through venture capital, through private equity, areas that retail investors don't necessarily have the direct access to. So it's important that the regulatory frameworks for institutional investors are tailored to allow them to boost their investment into these strategic areas too. This brings me to the second point then, which is more about the capital market efficiency point, because it's not enough to boost the capital that's available for investment, but it's about making sure that that capital can be transformed into productive and resourceful investment across all the EU. So we know that capital markets are fragmented for various reasons, whether it's to do with a lack of integration on trading or post-trading infrastructures, whether it's to do with divergent approaches to application of regulations or divergent supervisory approaches. There's numerous reasons. And in fact, the SIU strategy from yesterday is quite clear on this point, and it brings true a number of proposals that are aimed to address this. In particular, I was looking at the market infrastructure package and the supervisory proposals that are due by the end of this year. So they'll be quite interesting to see how we can challenge these market functioning issues. Finally, I think just to mention on the point of financial stability as part of this discussion and investor confidence overall. So how do we ensure that as we are scaling up investments for SIU purposes? Well, essentially, the financial regulatory frameworks that we have built over the years, financial stability and investor confidence and efficient market function have been core components of this. So as we go through a reform of those frameworks in the context of SIU, but also in the context of simplification and burden reduction, it's important that these components remain anchors to what we do, so that we don't necessarily focus overly on growth over stability. It's ultimately around following or finding the right policy mix.
Thank you for those comments. We are going to address indeed later on a little bit this aspect of the simplification in the next. I'd like to turn now to Adam and ask from the perspective of the one of the most important market functioning in Europe. What do you think could be the key focus to help the companies scale up?
Well, I think it's a very good question. I mean, it would be easy to have one answer, but there are, of course, many dimensions to this. Now, I head up the Nasdaq Stockholm Exchange, and I've had the privilege to work with the Swedish market for a long time. And when I compare it to many other European markets, I think the fundament is that we have an active equity participation, not only based on retail, but with the foundation of retail. Because if you create the foundation of retail, you then have smaller, mid-sized institutional money, you have family offices, you have then the commitment of local funds, you have the commitment of international funds, et cetera, et cetera. So from our perspective, many other markets really only have the top layer. And so when we have smaller, mid-sized companies that come to market, many of our banks and the ECM teams can work with these companies to get institutional traction. And then they can add the layer of retail, not only on the day of the IPO, but over time. And I think that's equally important, so that really making sure that smaller mid-sized companies can get access to institutional money, because we were talking a bit earlier about having responsible owners, knowledgeable owners, supporting the companies in that transition. So I think that's why we have been so successful in the Nordic markets, not only based on retail itself, but the foundation that retail has allowed the market to create, with a strong stability of institutional capital over time. I think the other aspect is that the Swedish market is manageable. It's accessible from a cost perspective. If you look at the US, we're talking about the US all the time, that it's such a great market. It costs 10 times as much to list in the US. The regulatory burden and the regulatory risk to be listed in the US is substantial. Now, still companies want to list in the US, and that's based on the return of investment. The return of investment is that they get access to institutional capital in a way that they feel that they do not get here in Europe. So from our perspective, it's important to make sure that we're maintaining a regulatory balance and not over-regulating, because we want companies, the symbiosis between the private companies having a predictable access to the public markets, so that transition is as smooth as possible without being fundamentally burdensome and revolutionary for that company. It should be evolutionary. So from that perspective, I think we have created an unpredictability in Europe, and it's becoming a bit of a whispering game where some of the EU regulation in Europe is interpreted in 27 different ways. Now, that fundamentally is a catastrophe, because even in the Nordics, we have 4 different interpretations of MAR. And those are all the same Nordic investors. There's not one investor that just invests in Sweden. They invest in Finland, they invest in Norway, they invest in Denmark. But they have to figure out how we interpret MAR in each respective country. Now there's a new layer of interpretation. It's the foreign direct investment. There's 4 interpretations of foreign direct investment. Now, that regulatory interpretation and that regulatory arbitrage that is being created in Europe is detrimental for the long-term confidence of being able to navigate the European capital markets. So again, from my perspective, it's not about reducing the cost necessary. We've seen that in the US, because if you, from a cost perspective, it is costly to list in this, but there is a return of investment. We have to focus on the return of investment and making sure that when companies access the public markets, it's in a predictable way, and they get access to public money in a substantial way. And not only from a later stage, but the ability to grow from a smaller company in the public markets to a larger company. And one good example there is that we have a growth market called First North, and all European exchanges have growth markets, MTF structures. We just celebrated with a Finnish company in the Nordics now, 140 companies that transition from First North to main market. That transition, that stepping stone mechanism is fundamental. Probably out of those 140 companies, I would say roughly 80% would not be listed today. And that means that a lot of the pension capital and that would not have been able to participate in that growth that has been created. But I was also listening to the previous talker earlier today talking about that the capital markets just focus on creating return of investments. I think it's another dimension of this, is that if we don't invest in these smaller, mid-sized companies, I just came from London, there's a lot of capital in London, but it's less and less allocated to smaller, mid-sized companies. And it was not too long ago we were talking about London being the center of focus, about being the successful capital market that everybody envied. It's gone very quick. So from that perspective, I think the responsibility of the capital markets is to support innovation, support growth on a local basis, not only measuring return of investment and only gravitating to Magnificent Seven or granolas. It's really about making sure that you're funding innovation that can create jobs, spur different innovation on a local basis, and make sure they then have the capacity to access capital in private markets, in public markets. Because then you create really growth. And that's, for me, fundamental, that you don't not only measure it in terms of return of investment, because then everything will gravitate to the larger companies. And I think that's where, those are some reflections that I think are very important. Make sure that we create a harmonized interpretation of rules, make sure that the transition from private to public is evolutionary, not revolutionary, and I think make sure that you get access to smaller mid-sized companies get access to institutional capital, because retail are not professional owners. They are followers, but they want to participate. And we've seen that now with defense, we've seen that with green transition. They want to support companies that have a great vision and that are doing something good. And so from that perspective, it's the most democratic way to engage population to make sure that companies access the public markets. So again, these are all fundamental aspects, and the Swedish market is a great example, but it's important that the Swedish market continues to evolve, not only talk about how great we are now, because we've seen what the London example, it went very quick. So it's important that we learn from others in terms of new initiatives, and we see what other countries are trying to do, because I think we can learn from each other.
A lot of food for thought, which are very interesting, especially transitioning now with Maria, because having heard, the comments from previous speakers, we'll be interested from your perspective of a technology provider worldwide. How do you see, what else could be done actually to facilitate, accelerate the green and the digital transition for the corporates in the EU?
Thank you, Florence. And I'm gonna give us all a break from the SIU, so I'm gonna focus on other aspects, which I think it's in line with what the minister was saying earlier today. What are the conditions that need to be in order to make European businesses competitive? And picking up on the previous panel, reasons to be happy. I think other than the weather, lovely weather, there are some positive signs in terms of the adoption of technology and the level of digitalization of businesses of all sizes across Europe. We just released a report that we commissioned, and in the report there's a survey around the adoption of AI, and we've seen an increase of 37% from last year. And this is across all businesses, again, of all sizes. And why this is important? Because 3/4 of those companies that were surveyed are seeing increase in productivity and increase in revenue. And that translates into more competitiveness, and jobs and more investment in Europe. So the adoption of technology and it's absolutely fundamental. But I guess going back to what conditions, what other conditions other than financing, and acknowledging obviously financing and access to capital is absolutely critical, but what other conditions are important to facilitate the digital transition? First of all, I would say creating a pro-innovation environment. And that is connected, I think, with ensuring there's access to technology to all companies across Europe from all sizes. And when you think about if you are a company and you have to dedicate almost half of your budget to compliance costs with regulation, that does not facilitate that transition. Also, uncertainty around regulatory requirements, for example, on AI, but also on operational resilience, for example. The uncertainty does not facilitate the adoption of technology that businesses need. And the second one is, and it's been mentioned several times, and I'm happy it's been mentioned, is addressing the skill gaps in Europe on the technology side. And what we are seeing right now, and part of the report that we published also touches on that, is that there's almost a risk of having a two-tier economy, which companies that have those skills can actually modernize themselves and transform themselves and be more competitive when others kind of lag behind. So there's definitely a space for action there. And I think at the European level, there are several initiatives, and we certainly as AWS are putting a lot of effort into offering skills. But again, just going back to the point around creating the right environment, very happy to see the simplification agenda. I would wanted to see how it works out in practice. And again, we have two live examples where I think there could be some action needed in terms of guidance. You had mentioned before how helpful guidance would be. AI, making sure businesses know what they need to do when it comes to compliance. I find myself in conversations specifically on the FS side, but I know it's across all sectors around not really being sure what their obligations are. And that kind of has an impact on delay of adoption of technology, but also on, if you think about cloud being the foundation for AI, any delays or any requirements that indirectly or directly potentially impact the adoption of cloud could have a detrimental impact for the digital transition. So action on those two specific issues, I think, are absolutely fundamental for the digital transition in Europe.
Thank you. Interesting. Now we are going to move on.
comment, but simplification and fragmentation don't go together. And I think if that applies to markets, banking, etc., etc. And if you look at the example of DORA, and I can't help mention DORA, but DORA was meant to be introduced to harmonize requirements on operational resilience across the EU. Question right now is how the supervisors are going to implement it, enforce it. And we are yet to see how that happens. And I'm hopeful, but I still have questions from the discussions I've had with regulators. So, and as Joe was saying, I think simplification is not about rolling back rules. We're not talking about that. It's just making sure that there is regulatory certainty, that it creates the right conditions for innovation and for competitiveness. And we talk about the digital transition, but also the green transition. And technology and sustainability, I think, go hand in hand. If you think about the businesses and corporates across Europe trying to hit their sustainability goals by leveraging best-in-class technology, for example, like cloud, where they can leverage the scale of providers like us and really decreasing the energy consumption, the time they have to spend training models, for example, for AI. And so, they go hand in hand. So again, ensuring that we have the right conditions for corporates and for financial institutions to adopt technology, it's crucial.
Thank you. I think we are almost at the end of the session, and I don't know whether I can go to a last tour of wish list or if there are any questions, because I will go very. No, I'm sad that everyone maybe wants to have lunch, but I can give just one word if you want to have a wish list on your plate. What would it be? Starting with you, Ariad.
Number one, that policymakers and supervisors understand that rules and their practices can also harm confidence and competitiveness just as they support it. The balance is really important, and I often find we don't strike the balance. And secondly, that you think along private money and markets whenever you think about financing transition, innovation, and sovereignty.
Maria?
Let's say increasing the dialogue between the whole ecosystem, between regulators, supervisors, and technology providers, financial companies. I think just so regulators and policymakers get a real feel for the impact of those regulations.
Thank you. Adam?
And I think focusing on making the transition from private to public predictable, evolutionary, and manageable, I think is a key aspect here, not just focusing on the two parallel worlds, making that transition manageable and predictable and worthwhile. The other aspect is simplification and interoperability, making sure that Europe really is interoperable from a settlement point of view, from a regulatory harmonized point of view, because that's one way of strengthening the capital market pool, making sure that it's interoperable. Right now, it's not really that. It's still many pools of capital which are not interoperating.
And Joe?
Maybe just to say on capital market functioning and efficiency, it's important that, yes, we have that regulatory and supervisory consistency. The market itself is the middleman between the capital and the companies. So it's important that it operates in a more pan-European way, and that supervision and regulation is consistent and is applied in a way that makes this a more seamless activity overall.
Thank you. This is a sign of, let's say, wish and optimism. Maybe before you go all for lunch, and thank you for the speakers for being with us. Thank you, Joe, for joining online. And now it's the lunch.
Thank you.
Thank you.